If you were born before 1965 and you or your spouse ever worked in a government job, a teaching job, or any public sector position, there are 3 lesser-known Social Security rules that could be affecting your benefits right now in 2026, and most people have never heard a clear explanation of any of them. These are not new rules exactly. They're the result of a major law that passed last year, but the way it's playing out in 2026 is creating real confusion, and in some cases, real money being left unclaimed. Let me walk you through all 3, one at a time, so you know exactly where you stand. To understand all 3 of these rules, you need a little bit of background first. For more than 40 years, 2 provisions in the Social Security Code, known as the Windfall Elimination Provision and the Government Pension Offset, reduced or completely eliminated Social Security benefits for people who also received a pension from a job that didn't pay into Social Security. This affected teachers in many states, firefighters, police officers, and federal employees under the older civil service retirement system. In January of 2025, Congress passed the Social Security Fairness Act, which repealed both of these provisions completely and made the change retroactive back to January 2024. On paper, that sounds simple. In practice, in 2026, there are still 3 specific situations creating confusion and, in some cases, costing seniors thousands of dollars if they don't understand them. Let's go through each one. The first rule has to do with how far back your payment actually goes, and this is something a lot of people are getting wrong. If you were already receiving a reduced Social Security benefit because of these old rules, the law is fairly straightforward. SSA recalculated your benefit and sent a retroactive payment covering the difference back to January 2024. According to SSA's own reporting, by mid-2025, they had completed the vast majority of these cases, sending out more than 3 million payments totaling around $17 billion. If that's your situation, you've likely already seen this resolved. But here's where it gets complicated, and this is the first rule you need to understand. There's a second group of people who never applied for Social Security spousal or survivor benefits in the first place, because for years, SSA itself told them their benefit would be reduced to 0 anyway under the old government pension offset rule. So why bother applying? Many of these people simply never filed a claim. Now that the offset is gone, the natural assumption is that they'd be entitled to the same retroactive treatment, back to January 2024, just like everyone else. That assumption turns out to be incorrect, and this is the part that's catching people off guard in 2026. Social Security has a long-standing general rule that limits retroactive payments for new applicants to 6 months before the date you file your application, not back to January 2024. So if someone in this situation files their claim today, they may only receive 6 months of retroactive pay, not the full period going back to January 2024 that current beneficiaries received. This has become enough of a problem that a bipartisan group of senators, including Susan Collins, Bill Cassidy, John Cornyn, and John Fetterman, sent a formal letter to SSA in early 2026 specifically pushing back on this interpretation, arguing that the law makes no distinction between people who were already receiving benefits and new applicants for spousal benefits. As of now, SSA's policy on this point is still being reviewed, but the practical reality for you right now is this. If you are a spouse or surviving spouse who never applied because you were told the offset would zero out your payment, you need to apply as soon as possible, because the longer you wait, the smaller your retroactive window becomes under the current 6-month rule. Waiting does not help you here. It actively costs you money, month by month. Now let's move to the second rule, which is related but slightly different, and this one affects a specific group of people that's easy to overlook. This applies to you if a family member, a spouse for example, worked in a public pension job and passed away, and you, as the surviving spouse, never filed for survivor benefits because you or someone at SSA Assume the government pension offset would reduce your benefit to nothing anyway. In one documented case reported in early 2026, an 81-year-old retiree who spent his career under the civil service retirement system never applied for spousal benefits for exactly this reason, and is now navigating the same 6-month retroactivity limit we just talked about. The reason this is being treated as a separate, second rule worth understanding on its own is because the math here can be substantial. If your spouse's Social Security benefit was, say, $1,800 a month, and you would have been entitled to 50% of that as a spousal benefit, that's potentially $900 a month that the old government pension offset rule would have eliminated entirely. Multiply that by the years since 2024, and the difference between getting full retroactive payment back to January 2024 versus only 6 months of retroactivity from your filing date can mean a difference of thousands of dollars. This is exactly the scenario the senator's letter to SSA was addressing. So if this describes your situation, or your spouse's situation, the action step is the same as before. Contact SSA directly and file your application now rather than waiting for the policy dispute to be resolved, since every month you wait is potentially a month of benefits you may not get back. Now, before we get to the third rule, let's talk briefly about who actually falls into these first two situations, because the groups are more specific than people realize. This applies to retired teachers in states with separate pension systems, including places like California, Texas, Ohio, Illinois, and Massachusetts, along with firefighters, police officers, and other state or local government employees who worked under a non-covered pension. It also applies to federal employees hired before 1984 under the Civil Service Retirement System, often called CSRS, rather than the newer FERS system that most federal workers use today. If you or your spouse fall into any of these categories, and you never filed for spousal or survivor benefits because you assumed you wouldn't qualify, you are exactly who these first two rules are about. It's worth checking, even if you're fairly confident the offset would have applied to you, because confirming your status costs nothing and only takes a phone call. There's also a practical reason this matters more in 2026 than it did in 2025. A full year has now passed since the law was signed, which means the gap between January 2024, when retroactivity begins, and today, when you might actually file, keeps growing wider for anyone who still hasn't applied. The longer this goes unresolved, the more this becomes a story about timing rather than eligibility. You may be fully eligible for these benefits, but the amount you actually receive can depend heavily on exactly when you file your claim, which is why understanding this now, rather than a year from now, makes a real difference. In the second part of this video, I'm going to walk you through the third rule, which is less about eligibility and more about something many people don't think to plan for at all: the tax impact of receiving a large retroactive payment in a single year. I'll also walk you through exactly what to say when you call SSA and how to check your own account today to see where you currently stand. Let's get into the third rule, and this is one that doesn't get nearly enough attention, because it's not about whether you're eligible for back pay, it's about what happens to your taxes once you actually receive it. Here's the situation. If you're one of the millions of people who received a retroactive lump sum payment because of the repeal of these old rules, that payment, depending on your case, could be several $1,000s, sometimes more, deposited into your account all at once, rather than spread out gradually over the months it actually covers. From a tax perspective, that lump sum generally counts as income in the year you receive it, even though it represents benefits you were owed going back to January 2024. For some retirees, this isn't a problem at all, but for others, particularly those whose income is already close to certain thresholds, receiving a large lump sum in a single tax year can push their total income higher than expected, which in turn can affect how much of their Social Security benefit is subject to federal taxation. Here's a simplified way to think about it. Social Security uses something called combined income to determine how much of your benefit gets taxed, and combined income includes your adjusted gross income, any tax-exempt interest you have, and half of your Social Security benefits for the year. A large one-time retroactive payment gets added into that calculation for the year you received it, which means some retirees who normally wouldn't have much of their Social Security taxed at all could find themselves temporarily pushed into a higher bracket for that specific year, simply because of the timing of the payment, not because their actual day-to-day income changed. This matters most if you received your retroactive payment in 2025, since that's the tax year you'd be filing for. If that applies to you, it's worth reviewing your 2025 tax return carefully, ideally with a tax professional, rather than assuming everything will sort itself out automatically. The same logic applies if you're still waiting on a payment and it arrives sometime in 2026. Knowing ahead of time that a large lump sum could affect your tax situation gives you the chance to plan for it, rather than being surprised by it next spring. So those are the 3 rules. To summarize quickly. Rule 1. If you never applied for spousal or survivor benefits because you assumed the government pension offset would reduce them to 0, you may now only be entitled to 6 months of retroactive pay from your filing date, not the full period back to January 2024, unless SSA changes its current interpretation. Rule 2. This same 6-month limitation applies specifically to surviving spouses in similar situations, and there's active pressure from lawmakers right now to change how SSA is handling these cases. But until that happens, the safest move is to file as soon as possible rather than wait. Rule 3. If you do receive a large retroactive lump sum payment, understand that it may affect your taxes for the year you receive it, so it's worth reviewing that with a tax professional rather than assuming it has no impact. Now let's talk about exactly what to do with this information, step by step. The first step is to check your own Social Security account directly. Go to ssa.gov and log into your My Social Security account, or create one if you don't already have one, which takes about 10 minutes with your Social Security number and a valid email address. Once you're logged in, look at your benefit statement and check whether there's any historical reference to the windfall elimination provision or government pension offset on your record. If you see one and you're currently receiving benefits, confirm that your monthly amount reflects the increase that should have applied starting in 2025. If you never applied for spousal or survivor benefits at all, your account may not show anything related to this, which is itself useful information because it tells you that you are likely in that second group who needs to file a new application rather than wait for an automatic correction. The second step is to call SSA directly if anything is unclear. Their number is 1-800-772-1213. When you call, the most useful thing you can do is be specific about your situation. If you previously didn't apply because you assumed the government pension offset would eliminate your benefit, say that directly, and ask the representative how much retroactive coverage applies to your specific case under current SSA policy. Given that this exact issue is under review following the Senator's letter to SSA in early 2026, it's worth asking directly whether there have been any policy updates on retroactivity for new applicants, since this is actively being discussed at the federal level right now. The third step, and this is the one people skip most often, is to talk to a tax professional if you've received or expect to receive a retroactive lump sum payment of any meaningful size. This doesn't need to be complicated or expensive. Even a single conversation with a tax preparer who can look at your specific income for the year can help you understand whether the payment affects your tax bracket and whether there's anything you should be doing differently for that filing year. I want to be clear about something before we wrap up. Every individual's situation here depends on their specific work history, their pension records, and when they file, which means the best source of accurate information for your exact case will always be the Social Security Administration directly, or a qualified tax professional for the tax-related questions. This video is meant to give you a clear, honest overview of 3 issues that are actively affecting people in 2026, not to replace personalized guidance from SSA or a financial professional. If you or someone you know worked in public service, taught school, served as a firefighter or police officer, or was married to someone who did, these 3 rules are worth understanding clearly, because the difference between knowing about them and not knowing about them can be measured in real dollars. If this was helpful, consider sharing it with someone who fits one of these situations: a retired teacher, a widow or widower of a public sector worker, or anyone who was told years ago that applying wasn't worth it. A single phone call to confirm where they stand could make a meaningful difference. One last thing worth keeping in mind as 2026 continues: this situation is still evolving. The letter from senators pushing SSA to reconsider its retroactivity policy was sent earlier this year, and how SSA ultimately responds could change the specific numbers we've discussed today. That's exactly why checking your own account periodically, rather than checking once and assuming the situation is permanently settled, is the more reliable approach until SSA issues a final, clear policy on these remaining cases. Thanks for watching, and I'll see you in the next video.